Another branch of accounting is cost accounting. Now we shall get into cost accounting. Financial accounting has many limitations. For example, it does not give any clear idea of the operational efficiency. You are running a company, but whether you are running it efficiently or not, whether all of your processes are cost effective, whether there are certain areas where you can improve your efficiencies, all these are not there in financial accounting. Financial accounting also does not help you to fix prices. And as you know, many times companies practice differential pricing. In one market they offer one price, in another market they offer another price. Now that kind of decision is very important for a business. Financial accounting does not help you to do that. It does not help identifying the areas of weakness. It only provides historical data and aggregate data. The data is not split between products, groups and services, so that further insight into the data and further insight into the cost is available. Naturally, in financial accounting, no analysis of loss is provided. You can have broad headings of incomes and expenses. You may know which heading you have incurred higher expenses in financial accounting, but when splitting those expenses into various products or groups or services, no help is available in financial accounting. Financial accounting also does not have any tool for cost control. That is why cost accounting has developed as a discipline supporting financial accounting in a very significant way. Coming to the definition, cost accounting is the application of costing and accounting principles, methods and techniques to the science, art and practice of cost control and ascertainment of profitability. What are the objectives of cost accounting? It wants to find out which activities are profitable and which are not. It helps to measure efficiency and even improve it. It provides data on which estimate and tenders can be based. Tenders, as you know, are to be submitted to the prospective buyers, and sometimes they are submitted in one part and sometimes they are submitted in two parts, but it always requires some estimate and some breakup of cost so that the prospective buyer is convinced that he is getting the best. It helps increasing profit by identifying sources of losses. It helps decision making in fixing price, in fixing capacity utilization. Sometimes you will see that even lowering the capacity utilization, you can make higher profit. We will shortly give an example. Whether to make or buy a part, maybe you are making a part in-house at a higher cost. It is available at a cheaper price in the outside market. Maybe it will be good for you to outsource one service rather than employing internal employees to provide their service. It helps determine the most profitable level of production. it also helps to decide whether an export order is profitable or not, because normally the price of export order will be lower than the domestic order. Whether the production of some of the products should be discontinued or not can also be decided through cost accounting techniques. Now I'll give you a simple example. It is very simple, in fact, because cost analysis may require much more detailed information. For the timing, let us continue with this minimum information. As per financial accounting, for example, in the books of the company, the material cost is 50,000, wages is 20,000, other expenses is 10,000, total sale of the company is 1 lakh, so it has a profit of 20,000. That means 1 lakh minus all these costs above, which is 80,000. So total profit of 20,000, profitability is 20%. It looks that the company is running very well. But if you analyze this cost into the 3 products A, B and C that the company is producing, then you will find the following data. Say material 20,000 for product A, 18,000 for product B and 12,000 for product C, totaling to 50,000. Similarly, wages 10,000 for product A, 6,000 for product B, 4,000 for product C, totaling into the same 20,000. And other expenses are also split accordingly. So the costs have been split and the sale price also has been split. Whatever sales have been recovered by selling these 3 products are also split. The control total is here, this total and this total is matching. And now you have individual profit of each of the products. Now you find that for product A, if I deduct from 50,000 the material cost of 20,000, wages of 10,000 and other expense of 2,000 rupees, then I have a profit of 18,000 rupees. Similar way, I have profits for product B and also profit for product C. As you see, product A is highly profitable, it gives 36% profit. Product C gives 23% profit. And product B is actually loss making. It is giving a 4,000 rupees of loss or 17% of loss. Now in this situation, if I remove or if I do not produce product B, then my profit will be higher. And that is there in the following table. Here, you say product A is having 36% profit, product C is having 23% profit, same as above. Product B has been totally removed. When product B has been removed, all the totals have changed. And now you see, with a lower turnover of 76,500, you are making a profit of 24,000. Earlier, you were making a profit of 20,000 on a turnover of 1 lakh. Now you are making a profit of 24,000 on a turnover of 76,500. Your requirement of working capital is coming down, pressure on your capacity utilization is coming down, and by producing lower quantities, you are actually making higher profit. This kind of decision is available in the cost accounting analysis. Of course, there could be another argument from the management side or from the visionary who is running the business. He may still want to continue product B because product B has a better prospect for the future. You never know, because all the eggs should not be put in one basket or profitable baskets. That kind of theory may also come out. But objectively analyzing, you can find that by removing product B, you can make more profit. Now it is up to the management to decide whether strategically they should remove product B, whether there is any other consideration to continue the production of product B. Now, from the earlier analysis and going by earlier discussion, we can more or less identify what are the difference between financial accounting and cost accounting. The purpose of financial accounting is to find overall profit and give a summarized position of assets and liabilities. Cost accounting is concerned with keeping financial and other information in a way that proper planning, operation, control and decision making is possible. Forms of accounts. Financial account is kept in a way that it meets the requirement of Companies Act, Income Tax Act, GST, etc. All these acts basically require you to maintain the books in certain formats or maintain the books giving certain aggregate financial information. Cost accounting book is kept in order to meet the requirement of management, but sometimes the law also provides that cost accounting books should be kept. In financial accounting, records of expenses are kept according to the nature of the expenses. In cost accounting, recording of expenses is made according to the purpose for which it is incurred. Financial accounting has emphasis on the recording aspect only, whereas cost accounting has emphasis on the detailed system with the help of standard costing and budgetary control. Standard costing itself is a separate subject which I will deal with separately in a separate exercise. The coverage of financial accounting is aggregate for the whole business, whereas cost accounting is more detailed. It discloses profit or loss for each product, job or service. Thanks for your attention.